Hey everyone, have you ever looked at a chaotic stock chart and wondered if the rigorous engineering principles we use to control complex machines, like industrial robots, autonomous cars, or even rockets, could genuinely be used to decipher financial markets? Welcome to this explainer, where we are going to explore exactly that.
This explainer is based on some fascinating work prepared by Dr. Nima Mahadian. You know, engineers are amazing at controlling machines, robots, and complex industrial processes. But can we actually take those exact same ideas and use them to understand financial markets? It is a huge paradigm shift. Instead of viewing the market as a random casino where we just helplessly guess numbers, we can actually approach it as a complex dynamic system that can be measured and, more importantly, managed.
Okay, let's dive right into this. Here's the structural blueprint we're going to follow today. First, we'll map machines to financial markets. Second, we'll look at the dynamic market system. Third, we'll talk about tuning the trading engine. Fourth, real-world market applications. And fifth, future systems and the very real risks involved.
All right, let's kick things off with Section 1, Machines to Financial Markets.
So imagine you're building a factory control system. You've got a target state, a controller, the process itself, and some kind of feedback mechanism taking in real-time measurement data, right? Well, a financial market can actually be structured the exact same way. Think about it. Your reference input is basically your target financial state. The controller? That's your intelligent trading algorithm. The process is the live market itself, and crucially, the feedback mechanism takes in all that raw market data and continuously adjusts your system on the fly.
And this brilliantly illustrates a core difference in philosophy. On one side, we have prediction. It's like staring into a broken crystal ball, trying to guess the exact future path of a highly uncertain market. Honestly, that just has a massive failure rate. But on the other side, we have a steering wheel. This represents control. Instead of trying to flawlessly predict tomorrow, we're using a model-free steering wheel to dynamically adjust our capital based on current trajectory errors. You're actively steering the portfolio back to profitability as conditions change, totally removing the need to predict the future perfectly.
Moving right along to Section 2, the dynamic market system.
To really grasp this, we need to translate engineering concepts directly into finance. This lexicon bridge matrix does exactly that. Think of the input as the engineering fuel, which in finance is your initial investment capital. The output of a machine is its speed or temperature. Financially, that's your cumulative gain or loss profile. Now, the disturbance is like sudden wind or friction acting against a car. In the market, that represents volatility and sudden news shocks. And finally, feedback. The sensor readings in engineering become your real-time account value updates.
Let's make this super concrete with familiar, everyday control systems. A thermostat automatically senses a temperature drop in the room and instantly turns on the heat. Or think about your car's cruise control. You hit a steep hill, and it injects more fuel to maintain exactly 60 miles per hour. Now apply that exact same logic to a portfolio manager. Capital flows of the fuel, asset allocation is the engine, and real-time market data is the feedback loop. When the market slows down, the controller instantly reacts to that feedback and scales up exposure to maintain the expected yield. Now, what's really interesting about this next part is how we actually build it. Let's look at Section 3, Tuning the Trading Engine. Welcome to the PID dial board. Looking at the simulated stock response curve, our ultimate goal is to hit that target line. And to do that, engineers adjust three very specific reactive tools: the proportional, integral, and derivative controllers. Instead of throwing complicated math equations at the screen, we're just framing these as tuning dials. The entire aim here is error minimization and keeping the trading system totally stable.
Let's break down exactly what each of these dials does, step by step, because they each serve a totally unique role. First up is the proportional dial, or P. This reacts to the immediate size of the market dip. It literally scales your trade size directly in proportion to your current loss or gain. Next, we have the integral dial, or I. This one looks at the accumulated duration of the dip. If a loss is just dragging on, it increases your exposure to force that long-term error down to zero. And finally, the derivative dial, or D. This reacts to the speed of the dip. It anticipates future trends based on the rate of change and acts like a shock absorber, dampening the impact to prevent your portfolio from overshooting during a flash crash.
Okay, but what happens when your initial market prediction is just completely wrong? Check out this adaptation phenomenon. Say a trader predicts the market is going up and starts with a long position, but then, boom, the market drops abruptly. A traditional static trade would just sit there and build up losses. But watch what happens next. That integral action we just talked about, it kicks in.
The system autonomously adapts, recalibrates, and actually flips a failing long position into a short position to immediately capture that sudden downward trend. Pretty amazing, right?
So, does this actually work outside of theory? Let's check out Section 4, Real-World Market Applications.
Let's run a real-world stress test. We're looking at 175 days of raw Apple stock data, tracked at 2-minute intervals. Your initial capital is $10,000. Over this specific period, the market plunged. Now, if you used a traditional buy and hold strategy, you suffered a massive 32% portfolio drop, ending with just over $6,700. Ouch. But the PI controller? It successfully adapted to the plunge. It actively scaled its exposure to capture the market mechanics and actually ended with over $28,000 in profit.
Now let's see how this builds when we look at drastically different assets, like Bitcoin versus gold. Bitcoin is notoriously volatile, massive rapid regime changes. For a system like that, an engineer would heavily crank up the derivative dampening just to survive those sudden flash crashes. Gold, on the other hand, is a very stable system with slow, macro trends. So for gold, you'd patiently turn up the integral gain, letting the system accumulate history to recognize and scale into that subtle long-term trend.
But here's the catch. Financial markets change continuously and abruptly. Because of that, traditional fixed PID controllers can actually fail during sudden, extreme market shifts. This evolution matrix shows why we have to move toward adaptive and intelligent control systems. We are upgrading from basic reactive tuning up to adaptive control, which auto-tunes itself on the fly, all the way to reinforcement learning, where AI agents learn the absolute optimal policies via trial and error for high-frequency trading. Which brings us to our final part, Section 5, Future Systems and Risks.
The absolute cutting edge of this space is autonomous trading systems powered by deep reinforcement learning. We are moving completely beyond static parameters now. We're talking about AI neural networks that continuously learn and rewrite their own control laws based on tick-by-tick market feedback. Engineers are literally building digital shadow markets, perfectly simulated twins of the economy. This allows them to stress test their algorithms against millions of simulated economic disasters before they ever risk a single cent of real capital.
But hey, it's time for a crucial reality check. These control methods are incredible, advanced decision support tools for risk management, but they are absolutely not magic money printers. You have to beware of the frictionless illusion. Mathematical models often assume zero transaction costs, but real exchanges hit you with hidden fees and slippage. Then there's the margin call danger. A system might suddenly demand massive capital to adjust, forcing your broker to just shut you down. And finally, face the drawdown reality. Having a statistical edge does not prevent severe, terrifying temporary account losses along the way.
So what is the big takeaway here? Ultimately, control engineering is not about magically controlling everything. It is about understanding systems, respecting uncertainty, and making significantly better decisions. We can't eliminate market chaos, but by viewing the market through this engineering lens, we can navigate that uncertainty with incredible intelligence. So, the next time you pull up a chaotic financial chart, ask yourself, are you just guessing? Or are you ready to start engineering your portfolio? If you enjoyed this explainer, please subscribe for more content covering control engineering, AI, automation, and intelligent systems. Thanks so much for joining me on this journey today.